For nearly a century, the popular story of the Great Depression has centered on greedy Wall Street speculators. The narrative tells us that reckless gambling triggered the 1929 stock market crash, and that crash dragged the rest of the country into a decade of poverty. But that story ignores a statistical anomaly. Throughout the Roaring Twenties, only about 2% of the American public actually owned any stock at all. This chart tracks the U.S. unemployment rate during that era. If the stock market crash directly affected such a tiny sliver of the population, how do we explain a nationwide employment collapse where nearly 1 in 4 workers was out of a job by 1933? The underlying cause of the Depression was much quieter than a stock market panic. It was a textbook case of the law of unintended consequences, driven by specific government and Federal Reserve policies. Humans predictably respond to economic incentives. When policymakers rewrote the incentives governing the country, they forced everyday people to make decisions that doomed the nation. In the 1920s, the Federal Reserve was a young organization. In 1927, the Fed wanted to help Great Britain return to the gold standard. To do this, they lowered their discount rate, the interest rate member banks pay to borrow money, down to 3.5%. This chart shows the volume of corporate common stock issued during that time. That rate cut flooded the economy with cheap credit, overheating the system and inflating a speculative bubble. Realizing the market was overheating, the Federal Reserve panicked. In 1928, they attempted to correct their mistake by abruptly hiking the discount rate to 5% in less than a year. Here is a chart of stock market prices from 1920 to 1932. By suddenly choking off credit, the Fed triggered the exact collapse they feared. Production slowed, and investors realized their expectations were no longer realistic, leading to the crash in October. By manipulating the domestic money supply to solve an international monetary problem, the Federal Reserve engineered a severe economic contraction. When the stock market crashed, it hit a financial sector that was built to break. The American banking system functioned on fractional reserve banking, meaning banks keep only a small percentage of a customer's deposited cash in the vault, while lending the rest out. Look at this chart detailing bank reserves. The cash banks had on hand dropped from over 12% to just 2.1%. Now look at the country banks row. Unit banking laws prohibited opening multiple branches to protect small communities. These laws forced rural banks to remain small and isolated. Because they couldn't expand, their loan portfolios were undiversified. If a bank only loaned to local farmers and crop prices dropped, the bank had no profitable accounts elsewhere to absorb the losses. This chart tracks bank suspensions. As panicked depositors rushed to withdraw their money, over 9,700 American banks failed between 1929 and 1933. By contrast, Canada, which allowed an extensive branch banking system, suffered 0 bank failures during the same period. Laws designed to protect local banks prevented them from diversifying their risk, making them more susceptible to failing during a downturn. Herbert Hoover is often remembered as a champion of laissez-faire capitalism. In reality, he was a progressive government planner who believed in aggressive intervention. Hoover argued that maintaining consumer spending would stabilize the economy, so he pressured corporations to keep wages artificially high, attempting to protect worker paychecks even as the economy contracted. The economic reality was that production was slowing and business revenues were declining. Companies did not have the cash flow to sustain peak 1920s wages. Forbidden from lowering wages to survive the downturn, businesses had only one option left. They stopped hiring new employees and fired their current workers to cut costs. By using government mandates to protect worker incomes, the Hoover administration destroyed their jobs, transforming a severe recession into the Great Depression. These 3 policy failures converged to choke the American economy. A whiplashed money supply triggered the initial panic. Structurally weak union banks wiped out savings, and an artificially paralyzed labor market left millions unemployed. The Great Depression was a preventable tragedy, actively worsened by the very people trying to manage it. This historical disaster illustrates a concrete economic law. People and markets always respond to incentives on the margin. When the cost of doing business outweighs the benefit, activity stops. Modern interventions, whether we are talking about interest rates, taxes, or subsidies, alter human behavior in ways that extend far beyond their stated goals. When evaluating any public policy today, it is not enough to judge it by its intentions. We must look past those goals and anticipate the unintended consequences.